Hi, I'm Hunter Hutt, Director of Business Development, and today I'm virtually here with Andrew Torres, CEO and founding partner of Lawrence Park Asset Management. Today we're here to discuss the recent performance and opportunity set in the CI Lawrence Park Alternative Investment Grade Credit Fund, as well as quickly discuss our outlook and some opportunities we're seeing going into 2021. November was a risk-on month for most assets, including credit, as our fund was up 1.7% in November. Andrew, do you mind highlighting some of the main contributors to the performance throughout the month?
Yeah, certainly. Hunter, as you said, it was a strong month for risk assets generally. Once the election, U.S. election became a more definitive result, then that was a signal that that potential volatility event had passed. Combine that with the vaccine headlines we got later in the month, that some high efficacy vaccines were rolling out. We generally saw risk assets rally pretty strong into the end of the month, and credit was no exception. We saw very good performance from our portfolio. In particular, we had a few good names. So there was the broad credit tightening, but in particular, we had a few special situations that worked out very well for us. The first was MCAP, which did a new bond issue late in the month. We had been positioning in some 2022 bonds, which had been trading at pretty wide spreads relative to earlier in the year. And the company, as a result of a successful new issue, announced that they were going to tender for those 2022 bonds. And we saw those tighten over 100 basis points in a single day on the back of that announcement. We also had very good performance from bank capital notes. The LRCN notes that have been issued this year performed very well. And finally, a name called Chartwell Retirement Residences was doing well. Perhaps you could say because of the potential vaccine and the improvement that would give to senior home care.
How are we setting up the portfolio going into 2021?
Yeah, it's fair to say that we have seen a tremendous rally in credit spreads. 90% of the widening that we saw in March and April is now being recouped. In fact, we were looking at some stats earlier today. About 70% of our portfolio now is trading within about 10 basis points, or in some cases even through the tights of earlier this year. But we still have about 30% that's trading more than 25 beeps wide of levels from earlier in the year, and even 10% that's actually more than 50 beeps wide of levels from earlier in the year. So there is still room. It's the broad credit tightening has happened, but there's still very much story credits that if we get ongoing improvement and economic activity returning to normal in 2021, I think we can still see more performance out of this stuff. So we're trying to make sure we position in the right credits. I'd also say that we have extended the average term of the bonds that we own in the portfolio. And the reason for that is because we've seen such strong credit compression, the very short end of the curve is actually looking pretty tight. There's not going to be a whole lot of room from here for spreads to tighten. So really the stuff that we own in our portfolio, and we still devote a big chunk of our portfolio to those shorter duration 3-year and under bonds, but we're really looking at those as carry assets as opposed to performance assets going into the new year. Meanwhile, we've marginally extended, so we've moved more of our portfolio out to 5, 7, 10-year bonds, because we think if there's a further rally in credit assets, you're going to see credit curves flatten from here. So that's been a significant tactical move that we've made. To offset that, we've allowed the leverage of the portfolio to come down. So we're carrying about 1 turn less of leverage than we were earlier in the year.
And so, what are some of the outlooks and opportunities we're seeing going into 2021?
I think as I said, we're still pretty bullish risk assets. The hunt for yield is getting harder and harder because central banks are pumping the market with liquidity. You're seeing government yields, sub 1% in North America and still negative in Europe. So it's hard to find yield. The 2021 trade in fixed income is not going to be about duration. It's going to be about spread. So you're going to see buyers of spread assets, not buyers of duration assets. And for our strategy, which is made up of investment grade bonds, but with interest rate hedges in place, we really are a pure play in investment grade credit spreads, which is difficult to get from traditional fixed income assets. So I think if you're constructing a portfolio for 2021 in fixed income, you need to be thinking about high yield, private debt, mortgage-backed bonds, and I think you should have a sleeve in alternative fixed income, alternative investment grade, because those are the kind of assets that are going to perform if we see this vaccine rollout and this return to normal economic activity the way we anticipate.
Thanks again, Andrew. If you have any questions regarding our mandates, please feel free to reach out to one of our team members. From Lawrence Park to you and your families, we hope you have a very happy holidays and take some time to relax. Thank you and stay safe.